Everybody, welcome to the morning market briefing, hard hat edition. Hope everybody out there is doing well. Big day to coming through. I heard some guttural reactions from Tom. We're talking CPI, looking for a year-over-year headline number of around 7.2, year-over-year, excluding food and energy of 5.9. I don't think Tom liked what he heard, but Tom, take us through it.
Yeah, so what's interesting is that I'm not sure when it changed, but 7.2 was the expectation. Though when I pulled up the economic data page for Bloomberg just a few minutes ago, it had been revised up to 7.3 just before 8:30, which is not a good sign. And the number came in at 7.5% year over year CPI. So we got a hotter number than expectations, perhaps the hottest number we've seen in I'm gonna have to look and see how far back it goes since the last time we saw a 7.5% print on CPI year over year. Ex food and energy, the expectation was a move up from 5.5 to 5.9, and we came in at 6%. So that was also an acceleration. I know Ben's looking through the deeper details on what the numbers were. I think he said that used cars were up 40.5%. In terms of inflation year over year based on the current numbers. So Ben, why don't you jump in on some of the deep dive details?
Yeah, it's pretty interesting because I think that was a piece that I was thinking was going to decelerate, but it actually looks like that it accelerated. So used car prices were up 1.5% on just a month over month basis. So you're talking about 20% on a year-over-year basis. So maybe a little bit of deceleration in that number, but certainly 40.5% on a year-over-year basis is extremely high. Tobacco and smoking products were up 7% year-over-year. New vehicles up 12.2. But that's what really was driving things was the transportation. Interestingly, owner's equivalent rent was only 4.1% up on a year-over-year basis, which was basically what it was last month as well. I continue to think that could have some acceleration over the course of the year while we see deceleration in used car prices. I think that we're running about 0.1 or so higher than we had thought about 3 or 4 weeks ago when we issued the macro presentation. But I still think the trajectory is broadly in line with what we had expected, and that is that we're looking at probably some peaking in terms of inflationary pressures in February or March, certainly by the end of the spring. So that's what I would anticipate, driven by the vehicle prices, because as long as those vehicle prices are up 40.5%, I mean, that's a big component. That alone is 4% of the overall calculation, which may not sound like a lot, but that's 1.6 total percentage points within that 7% number. And especially if you strip out food and energy, you're talking about 1.6, 1.7 percentage points within the 5.9 or 6% number. So as that kind of comes off and you got new vehicles coming off as well, I would expect a little bit of normalization in that number over the balance of the year. But for now, an extremely strong inflation print, which is going to certainly take the headlines for the day and probably for the remainder of the week.
Thanks, Ben. Looking at market reaction, not a whole lot of movement, really. The Dow was down for just a moment, but it's kind of rallied in the last 30 seconds or so in terms of futures. As you would expect, this has certainly implications on rates. Tom, yesterday we had the 10-year auction, which was very strong. We got a 30-year auction coming up today. How do you kind of digest the strength we saw yesterday with how those people are probably feeling right now?
Man, there's a lot going on right now. The yield curve is just pure chaos right now. As soon as that number came out, I had both screens up side by side, and everything turned from green to red. But what's interesting is we're seeing just extraordinary flattening of the yield curve. So a 2-year bond, you're getting paid 1.4%, 3-year 1.7, 5-year 1.87, and then 7-year you're gonna get 1.96, and then 10 years 1.98. So you're essentially seeing like very little difference between the 5 and 10-year treasury yield. So you basically get an extra 10 basis points, 0.1% for taking on an additional 10 years, between 5 and 10 years. So we're just seeing the front end of the curve just ratchet up significantly. I mean, the 2-year treasury is above where we started the year on the 10-year treasury at 144. So it's just, I mean, just chaos. And you're seeing, as you look along the yield curve, you can see spots where we're inverted in some places, which is odd, which is, there are spots between the 7 and 10-year where a 8.5-year bond, you're actually yielding more than a 10-year bond. And I think it's just purely based on reactionary trading that just hit a second ago. So I think it's going to normalize, but it's very, very odd. But what we're seeing is just a broad sell-off. I mean, yesterday we had that 10-year auction. Rick Santelli gave it an A++. It was one of the strongest 10-year auctions probably in the history of treasury auctions. I mean, 7% of the issue went to dealers. Everything else got eaten up. The bid cover was huge. And so there was a tremendous amount of demand for those bonds. And just the CPI number alone has put those people underwater for the next, I mean, they're probably 2 years underwater now based on the move on the 10-year treasury since yesterday. And we've got the 30-year treasury auction this afternoon. And part of me wants it to go very poorly because otherwise we're just going to end up with an exceptionally flat yield curve. We need some relief on the 30-year. The 30-year selling off would be indicative of growth and more of a healthy yield curve. But the 30-year is just, I mean, it's barely moved. It basically moved about 1 bip since we started, whereas, everything else is up significantly. So we're not seeing a lot of selling on long bonds. We're seeing a lot of people squatting on those. And so my expectation is the 30-year treasury auction might actually go very strongly because we're not seeing any selling there. So there clearly is some demand for 30-year bonds. The question is, if we get a strong auction and we don't see a little bit of relief and sell off in the 30-year, we're going to end up in a potential inversion situation very, very quickly, as the spread between the 10 and 30-year, is basically 20 basis points at this point. So something we're monitoring. I think it's an overreaction. I think that if you look at, potential hikes, we're at 5.5, so we haven't really moved up too much in terms of anticipated hikes for 2022. I think the potentiality for a double hike in March has accelerated with this number. When you dovetail that in with the very strong jobs number, but I mean, we've got a strong economy. That's the thing, is inflation and jobs growth are the fact that this economy is running hot. The issue is, can we cool it down so it doesn't burn itself up?
Good deal. Good analysis, Tom. Thank you. Switching gears a little bit, quite a bit. New York is easing up some COVID restrictions. They're dropping the mask mandates for businesses, some schools. We've seen similar moves already this week from other states like California, Oregon, and others. Ben, I mean, it feels like the narrative on COVID has certainly cooled down. It also feels like every time the narrative on COVID cools down, there's another variant or another caseload coming through. As you try to process not only the economic expansion, I think we're certainly out of the recovery phase, but it's economic expansion with this thing that's still pretty much in the headlines. How do you kind of digest that?
Yeah, I think it's probably good news. I think it's probably something that was already priced into the market. Frankly, I think that government tends to lag the economy, which tends to lag market reactions, markets price in, and then the economy reacts, and then government ultimately comes in at the end. And I think that's what we're seeing again here. I think it's probably good news for economic activity in those states as those states open up, because remember that a lot of those states have been closed for a long, long time. I mean, people are still just kind of going back to those banks, just going back to those tech companies in California. So I still think that there is some runway for growth in those areas.
Awesome. Thanks, man. Tesla, kind of a continuing story, at least thematically. We've seen this in isolation. At least we've talked about it here internally. But the state of California is suing Tesla. This is coming from the Fair Employment and Housing Department in California, saying that they have found evidence that Tesla's Fremont factory is a racially segregated workplace where Black workers are subjected to racial slurs, among other things. This is crucial for Tesla. I mean, I feel like the entire narrative on Tesla has been for the last several years, can they get production up and running? I think any distraction on this plant is a problem. It's the biggest plant in the state of California. Certainly not saying that the lawsuit doesn't have merits. But do you think this has any kind of real ripple impact on a company from a operations level then? Or do you think it's more of a headline and something the legal team will hash out?
I think it'll probably have an impact. I think it won't have an impact on the operational level. I think it could have an impact on sentiment over Tesla if it really gets big. I just don't expect it to get big. And I am always impressed by the consumer's ability to delineate between wanting a product and placing blame on companies for something else. I think that there's a lot of talk about boycotts of companies over time, and those boycotts just end up being a NIMBY, not in my backyard kind of a thing. Whether you're talking about production of Nike shoes, whether you're talking about production of Apple's iPhone, or whether you're talking about productions of Teslas. I think that ultimately people will judge these companies a lot, but then ultimately consume the product. And I don't expect a material impact for Tesla as a result of this.
Excellent. Lastly today, we'll throw it to you guys in a minute if you have any additional commentary on CPI, but we're wrapping up with earnings. We had Encanto blasting pre-market, not just to get us all fired up, but also because Disney reported earnings. Disney up quite significantly, very strong quarter for Disney. Stocks up close to 7.5% in pre-market trading. Great numbers on the Disney Plus subscription side, driven especially by the international market. Parks did well. They're adding more content to Disney Plus. They're keeping an eye on the sports betting realm, which I think is probably not a big surprise, just given the trajectory of those things. But overall, a pretty solid quarter for Disney. Ben, anybody else on the earnings side stand out to you?
I think Coca-Cola and Pepsi and Unilever is all in the consumer staples space, all getting hit on cost pressures. Unilever really getting hit on costs. And the thing is, they're not able to push prices through as much. Pepsi's actually pushing prices through to the tune of the high single digits, which is among the highest that I've seen. But their commodity costs are going to be up to low double digits. So they're seeing some operating margin compression there. Coca-Cola, same thing. So that'll be interesting to watch going forward today. And not really anything that we didn't know, but now we actually have some numbers to quantify that. And then Martin Marietta, producer of aggregates, cement, asphalt, they came out with their guidance for 2022 as well as their 2021 results. In terms of the organic average selling price per ton growth in 2022, so this is relevant for people with hard hats. You're talking 5 to 8% selling price growth for aggregates. So they're selling the same rock, but for 5 to 8% more. They actually expect 1 to 4% organic volume growth. So a good top line, probably about 6 to 12% in terms of overall growth for Martin Marietta, but the lion's share of that is going to be done on pricing. So it means your highways are going to start costing more. So that's an interesting, again, inflation in Coca-Cola, inflation at Ben & Jerry's ice cream with Unilever, and inflation even in rock. So something to watch as we go forward in this inflationary world.
Good deal. Yeah, and as we're sitting here, futures have certainly sold off a bit during the S&P futures now down close to 90 basis points. NASDAQ futures a little more growth oriented, taking a bigger hit as this rate hike, possible double rate hike, seems a little bit more imminent. Tom, any closing reaction? I mean, kind of lost in the shuffle. Good jobless claims, initial jobless claims report down for the third week in a row, better than expectation. Any other data what are you keeping an eye on today?
Yeah, the last thing I was going to jump in is I was looking here, and thanks to Twitter, we've got the update. But the last time we saw inflation print this high was March 1982. So 39 years, 11 months ago. And the ironic thing is it was actually coming down at that point. So we're on the way up, but in 1982, 7.5% was coming down in terms of inflation. So, I mean, it's going to be a tough day. You know, growth is going to get hit. Bonds are getting hit very hard, particularly short bonds, which is not usually how you would anticipate a rate move to go like this. But, you know, as always, we'll be grinding. Then we put the hard hats on because we knew it was going to be a wild day one way or the other. And it looks like it's going to be, it looks like it's shaping up pretty solidly in one direction.
It is, but it's kind of what we're here for. A couple blue collar guys, no big deal. We'll get through it. Hope you guys have a great day. We'll talk to you guys tomorrow morning.